For the last few decades, Bangladesh has been progressing towards economic advancements. Prioritizing strategic policies, infrastructure development, and digitization over the decades has helped Bangladesh to utilize its economic potential, such as demographic dividend, export competitiveness, remittance inflow, technology adoption, and greater supply chain integration. In the last decade, our GDP has tripled and our per capita income has reached well beyond $2,800 annually. Even during the pandemic years, Bangladesh fared better than its neighbors, particularly in the fact that Bangladesh had a positive GDP growth rate. However, in recent times, we have seen some of the most complicated economic challenges emerge for Bangladesh. Continuous shocks to the supply chain and market volatility at the global stage have overcast Bangladesh's economy. Foreign reserve has been dwindling rapidly, whereas we hit record high last year. Currency has depreciated uncontrollably, and inflation has trickled down to every cog of our daily lives. To understand what is happening and unwind the complexity behind the indicators, we must dive deeper into the ripple effects of the global turbulences in Bangladesh. Take a look at what are the commodities that we import that might have a greater impact in Bangladesh's economy. We're heavily dependent on importing fuel and gas for energy generation and transportation. We are also dependent on wheat, soybean oil, sunflower oil, and corn for our own food safety and security and for our animal feed. And all of these commodities experienced price hikes due to Russian-Ukrainian war and consequent sanctions. As a result, the global commodity market became volatile. Price hike in fuel had a trickle-down effect in transportation, freight, agriculture, textiles, and energy or fuel-intensive businesses. The shortages had to be managed through nationwide load sheddings. Now, we are growing very well in terms of export. However, in terms of import, the high volume of import is overshadowing our export growth. In the last fiscal year, $52 billion worth of exports came out of Bangladesh. However, at the same time, the amount of import reached $84 billion. This resulted in a trade deficit, which is a component of current account balance, which is now at a record negative of $18 billion. Although we're doing good in bringing in remittance, Bangladesh has sent over 900,000 remittance workers already in 2022. But it's not enough to offset the huge bill of import. As a result, our foreign reserve started dwindling. From over 46 billion a year ago, it's now well below 40 billion USD. And that's why Bangladesh is looking for loan support from IMF. As the declining foreign reserve and currency depreciation are interlinked, we see a deteriorating scenario in both indicators. Going back to our initial discussion on inflation, this currency depreciation also makes import bills rise in Bangladeshi taka as we need to buy the same things for a greater value in Bangladeshi taka. Hence, we see price hike in all the imported products and raw materials. Ultimately, this is leading to a widespread inflation, making our operating expenses for businesses rise and at the same time creating a dent in our pockets. The last thing to understand is that these indicators are highly interlinked and can have reciprocal relations, and they are all being impacted in a negative way at the same time, making this economic phase tougher to control for Bangladesh.